Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. U.S. equity markets bounced back at the start of this week following Friday's global IT outage that impacted several industries. And President Joe Biden's decision to drop out of the presidential race has some feeling a greater sense of uncertainty in the markets as the election becomes tighter. So how are the latest market developments influencing today's guest's market outlook? Joining the show today to share his latest market thesis, including the macro themes moving markets this week and what they may mean for you, is Fidelity Director of Global Macro, Jurrien Timmer. Despite the various recent events in U.S. politics, Jurrien emphasizes the resilience of U.S. financial markets, driven by strong earnings growth and anticipated Federal Reserve cuts. He highlights the current unique scenario where earnings are accelerating while the Fed prepares to ease rates, a rarely seen combination that is supportive for most stocks. The conversation between Jurrien and host Pamela Ritchie also touches on the ongoing shift in market dynamics with potential broadening and rotation away from dominant mega-cap stocks, which especially benefits small-cap and value stocks. This podcast was recorded on July 22nd, 2024.
So much has happened in the last week and a half, and yet markets seem to be sort of beating to their own drum. I mean, what do we call this? What do you call this?
Well, it's funny because I was on CNBC like literally 10 minutes ago, and the same topic arose, and my answer was and still is that the U.S. markets, financial markets, they can have flare-ups and there can be drama, there can be volatility, but when the fundamentals are in good shape, the market can withstand a lot of drama. And obviously, certainly we've had some pretty dramatic events happen in the political sphere over the past, even month or so. But the fact is that earnings are accelerating higher. The Fed is poised to cut rates in September. And many of the stocks that have sort of been left behind in the U.S. bull market, right, because the Mag 7 have so dominated, those stocks really are primed to benefit from that combination. I mean, if you think about it, how often is earnings accelerating? Are earnings accelerating while the Fed is cutting rates? I mean, that really rarely happens. Usually the Fed is cutting rates, and that's a sign of trouble, and earnings are falling. But this is like this is like a real soft landing scenario where the Fed sees the inflation data, still as somewhat problematic, but it's no longer a clear and present danger, so it will ease off the brakes a little bit, and an earnings cycle is underway, and that is a good backdrop, especially for the average stock, right? Like the cap-weighted S&P, and actually we can go to, where's my slide?
The relative story of it all, really.
Hold on, let me say, where's the PE? I can't find it. Anyway, but the cap-weighted S&P is at 24 times earnings, but the equal-weighted S&P is at 18 times earnings. So you got lower rates, higher earnings, and reasonable valuation for most stocks. That's a pretty good backdrop, and it allows the market to withstand some of these dramatic events coming from the political side.
And I mean, when we go so far, I'm going to sort of big picture stuff here, but it seems like the American exceptionalism story, or, TINA, whatever you want to call it, we've got to figure out what the dollar is doing and would do, and we still don't, that's a bit of a mystery there. But in any case, it seems like things are intact for U.S. equities.
Yes, so we have a cyclical bull market within a secular bull market. We have the AI story. We have, potentially a productivity story. Certainly there's a lot of capital spending going on. We still have a kind of shareholder-friendly equity culture here where companies who generate excess cash, and those companies are generally in the U.S., are returning some of that cash, if not most of it, to shareholders via, somewhat via dividends, but mostly via buybacks. And that's something that you don't see as much of around the world, in part because not as much cash flow is generated, but also in part it's not part of the culture. So the payout ratio remains pretty high here at around 75%. And you add that to the growthiness of the S&P versus, for instance, the European stock market, And, that's been the story for the last, decade plus. And there are really no signs that that's going to come to an end anytime soon. And like you said, what happens to the dollar obviously is a question mark now that the Fed is going to pivot or has pivoted or is pivoting. Maybe the dollar story becomes less strong because what we've had in the US is very loose fiscal policy and restrictive monetary policy, more so than in other countries, and that has kept the dollar quite bid. And so it's possible that that comes to an end, but we'll see. It depends on how far the Fed goes, and obviously in terms of the political arena, and this is a question for the long term, not the short term. But another dimension of that is the Fed's independence in an era of fiscal dominance, and what role the Fed plays in that. But again, that's
later.
not conversation today.
So I'm curious, just based on some of the things you're talking about, what the correlations are, and the idea of the S&P 500 being off because of the mega growers having, a little spate of underperformance here. And last week, I remember you said it was just interesting to know what could go up when the overall market is coming down, and to what extent that's important. You've put more into that in some of your graphs this week, kind of going into that question. And again, it's sort of a question: are there alarm bells there or not?
Yeah, and there's always some puzzle I'm trying to solve in the markets, and the puzzle I've been trying to solve really all year, and there's not an easy answer, is if we get this rotation. Of course, we had a broadening last fall into this spring. But that didn't really come at the expense of the market, right? So the cap weighted and the equal weighted both rallied 28% from October until April. So that was a win-win situation for everyone. But in the last week and a half since the CPI report, it's been more bifurcated. And so since the rotation happened a week and a half ago, S&P is down 2%. Russell is up 6%. And that kind of raises the risk, if you will, that if we truly get a broadening where everything else sort of catches up, and it comes at the expense of the Mag 7 or the Nifty 50, can the market actually go up given how large those stocks are? So I'll run you through a couple of slides. And so let's start with slide 6. And so on the surface, the market is pretty broad, right? If you think about it in absolute terms, you see the bottom panel there, 75% of the stocks in the S&P are above their 200-day moving average, which is a fancy way of saying they're in uptrends.
Right.
And the S&P, is making new highs. This is the equal weighted S&P, which had a nice breakout. And if you look at slide 9, that's the Russell 2000. So that's the small cap index. That has a nice breakout. So you can see that, you're seeing that broadening. But if we go to slide 12, this is where the conundrum comes in, because even though breadth, it's slide 12, the next slide, even though breadth in the absolute is pretty decent, and you can see that in the chart. So this is the next chart, not this one. So I have that as, okay. So you look at the orange bars, that's new highs in absolute terms, pretty robust, right? You can see an ongoing series of new 52-week highs.
Right.
And then the purple bars is the relative new highs, meaning how many stocks are making new highs in terms of their relative performance. And you can see a very narrow market there, really since about a year and a half ago. And typically, when you look at the shadings, so the red shading is when the market's very narrow on a relative basis. That typically happens at peaks. But of course, it's been a persistent feature now for some time. And so the question is, can the market go up when the mega caps have gotten so big that if investors rotate out of them, in a sort of a zero-sum kind of way, can the market actually hold up? And before I get to that answer, I wanted to show one other chart, slide 7, which to me was like the big, there's always sort of a a head scratching chart. It's the next one, the following. We're probably off on the sequence, but this is the rolling 13-week correlation between the S&P cap weighted index and the S&P equal weighted index.
That's a lot of correlation. Look at that.
Well, I mean, these are two indices with exactly the same constituents, right?
Which means the same stock names.
Yes. So they are normally perfectly correlated, 99%. But right now, the correlation between these two otherwise identical indices is only 36%. So that just shows you how dramatic this rotation has been over just the past week and a half. And so it's an interesting view into the market, because when we think about the market history, and we go to slide 13 now, historically, the market goes up, of course, we know that. And historically, over the long term, small caps tend to outperform large, value tends to outperform growth. And so in the bottom panel here, the purple line is the top 50 versus the bottom 450. And that makes sense, right? Because typically the big mega cap growers are like quality blue chip stocks that, are fine to have, but they're not going to knock the lights out in an up market. But you have these very few episodes, the Nifty 50 in the early 70s, and of course the dot-com bubble in the late 90s, where you have very strong periods of outperformance. And the problem with those periods is that those 50 stocks, or in this case only 7 stocks or 5, get so big that when the market mean reverts back to a more normal state of mind, the market doesn't always get spared. And it's hard to make a blanket prediction out of this, because there's only been really a couple of episodes where this has happened. So the early 70s on the left of that chart, the market actually was recovering from a bear market as it broadened. So that was a good story. But the late 90s, of course, the market basically imploded on itself, because these mega cap growers got so big. And then when the mean reversion or the rotation did happen, it came at the expense of the market, and the market fell 53%, which is not something I expect to happen, but it just shows you that it can become a math problem rather than a fundamental problem at times.
That's fascinating, and that's swift when that sort of thing happens. I'll put in a couple of questions. There's lots of questions actually rolling in here. One of them has to do with the cap weight of the stock market in the U.S. and this advisor is asking, is the Warren Buffett indicator applicable, which is sort of what the stock market is worth versus GDP. Is it applicable?
So I've looked at that indicator many, many times, and I don't think it's always somewhat applicable, but you have to adjust that indicator for essentially what has been a very powerful earnings story in the US, right? So the Warren Buffett indicator just compares the market cap versus GDP. And there are limitations with that, but you can think about, okay, that's a reasonable indicator, right? Because the market cap is a sense of valuation, and the GDP is sort of the earnings power of the economy. But the S&P is about half international now, right? So you would have to compare to global GDP and not US GDP, because Apple is not really, it's a US company, but it's not really a US company, right? It's a global company. And so that's one limitation. And the other one is that over the decades, profit margins have gone up because earnings have been strong. And so you would need to adjust that somehow for margin, right? So in other words, the market can look expensive on a market cap to GDP basis because the PE is high, and that's true, but the PE is high because margins are high, and therefore a high PE is justified. So there are always caveats with indicators like that. There is some truth in them, but to me, those are the two major caveats.
So interesting. Okay, great. A couple other questions here. So markets often react, Jurrien, to economic data releases. Are the regular revisions of previous months' data, is that a concern? So we've got some pretty heady, the CPI, for instance. Are you worried about the revision cycle?
The revision cycle is prominent, not so much, not at all actually with the CPI, because the CPI never gets revised because cost of living adjustments are set to it. But the basket, of course, is always changing. But revisions can be a big deal for the overall economic data like GDP, and the jobs report especially. And I think probably the viewer is referring to the jobs report that over the past few months, the downward revisions to previous months have been pretty noticeable. Um, but that can be in part seasonal. There's obviously seasonal hiring tendencies. And this is also why we tend to look at moving averages. And so overall, the downward revisions that we've seen just show a softening economy, which, in a way is good because that gives the Fed a little bit more confidence that the improvements that it's seeing on the inflation front are likely to persist and that the economy isn't yet again starting to overheat. And so I'm not too worried about revisions. It's part of the game, right? And if you think about just the math of the non-farm payrolls, right? I mean, I think the U.S. labor force, I think is something like 170 million people or something like that. And the payroll number that we obsess over every month
It's a fraction.
can be like
Yeah.
1,000, right?
Right.
If you divide 100,000 by 170 million, it's just a fraction. I mean, it's like a rounding error, right? So whether payrolls go up 200 or 100 or 300, it's important, but they're statistical models, and obviously they get revised. But it's just, it's a reminder that we're really kind of like counting pennies, when there's, when the economy is that large.
What do you
And
look at for a labor?
Sorry, and that's why the unemployment rate, I think, is a preferred metric, and it's what the Fed uses in its Taylor rule, and so that's why the household survey can be more important than the payroll survey. Sorry.
Yeah, no, that's exactly what I wanted to ask you. Perfect. Okay. Question about China. China had a rate cut yesterday. This changes the currency story a little bit. Is it a signal of major stimulus out of China that, to an extent, certain investors have been waiting for? Is this the beginning of something?
So for China, it's been a series of hopes of, the reopen, the big stimulus, and we're sort of in the post shock and awe world, I think, for China. Like, remember after the financial crisis, China was really a key player to kind of revive the global economy, right? You had the Fed doing QE, you had the cycle, of course, kind of doing what it naturally does anyway. But then China did this massive infrastructure stimulus, and that got commodities going, it got the whole reflation trade going. And we've had some iterations of that in the years that followed. But, China has kind of built everything, and it's probably overbuilt a lot of things. So there is less fiscal stuff going on, or at least there's still fiscal stuff going on, but it has less of an oomph on the markets, right? The fiscal could be, healthcare initiatives, like stuff that doesn't show up in the price of copper, for instance. Right. And on the monetary side, it seems that China is taking a much more incrementalist approach. So the news we saw was, a 10 basis point move. So I don't think we're going to see these massive swings, but it's moving in the right direction. And, emerging market stocks are doing better, even with China, but especially without China. So it's moving in the right direction, but I don't think we're going to see like the fireworks that we used to see.
So let's tiptoe into politics. It was a big weekend. We know what happened. Anything fundamental for reframing the so-called Trump trade? Anything new on the equity market or the bond market now that Kamala Harris seems to be the endorsed leader for the Democrats at this stage? What do we look to for the markets? I mean, are we just looking for gridlock again? I mean, that's usually the answer.
Well, let's pull up slide 23, the last slide. And it's funny. Whenever you go on TV, there's always the risk of a gotcha question, and the CNBC show I was on, they're very good people, and so I'm not blaming anyone. But the last question was, do you think Kamala Harris is better for the markets than Donald Trump? And my answer was, I've been in this business 39 years, and one of the reasons I've done well is by not answering those questions. So that was my answer. But
serious cold water on the whole situation. Yeah.
They had to laugh. But all kidding aside, The markets are deep. They're driven by fundamentals, and obviously policies matter. Policies over politics, we like to say here. And if you look at this chart, the bottom right is the 2-year return in purple and the 4-year return in pink following a presidential election. And you can see that the purple bars there's a lot of dispersion based on the outcome, right? Is it a Democrat? Is it a Republican? Is it a divided House? Is it a sweep? And so obviously there are differences and it matters. But what I answered in my question on CNBC was, if you wait long enough, if you're a long-term investor, you're just trying to save for retirement and you can wait 4 years, the difference in those pink bars is virtually, there's virtually no difference over the subsequent 4 years. And it just tells you that markets are driven by fundamentals, and whatever excesses happen on the political side, they get worked out, which is why we have a midterm election cycle, which often corrects any excesses of the presidential cycle. But even beyond that, the two biggest purple bars are a Republican sweep and a Democrat president with a divided Congress. And my sense is that we're going to have one of those two episodes, right? Either Trump wins in a landslide, takes the House and Senate with him, or Kamala Harris prevails, and she has an opportunity, right? Because she's a relatively unknown, right? A lot of people think she doesn't have the chops, which I don't know if that's true or not, but she has an opportunity in the coming weeks to actually really win over or disappoint a lot of people. And so, a Democrat president with a Republican House and or Senate, which I think is likely if Kamala Harris does prevail, that is the other then potential outcome. And those are the two most bullish outcomes going back to 1789, which is what I did here. And so I think the market is looking through this with its usual rational logic. And again, if the markets was not sitting on sound fundamentals, or it was at some incredible, manic extreme, then these headlines or these potential outcomes, I think, matter more. But markets in kind of a good space, right? You have growing earnings and easier rates, and valuations are not a concern for most stocks. And then the two likely outcomes, in my view, that we're looking at here are the two most favorable ones you can get in an election. So I think that's what the market is seeing.
Yeah, interesting. But still, as we started out the conversation, it comes back to sort of inflation and rates and earnings based on all of these other pieces.
Earnings and interest rates, right? And policies will affect earnings and interest rates, sure. But that's what it comes down to.
Take us to inflation, which is obviously the interest rate story, because you get her an awful lot about both choices politically would be inflationary, or the fiscal dominance story, and just leads to wondering whether the Fed, at the moment, I think there's 7 cuts priced into between now and a year out. It seems like an enormous amount of cuts when there are still questions about inflation, at least swirling. I mean, I don't know what you think, but.
Yeah, so let's go to slide 2, the second slide. And I think the market is expecting the Fed to go to 3.5 over the next couple of years. And, that's in a couple of years, so who knows what the story will be by the time we get there. To me, that seems ambitious, right? And I look at it in a very simple way. A real rate, like a neutral policy in real terms, is probably plus 1%. That's where our star is. That's typically where rates would be in an expansion. So you got plus 1 real, and then if inflation's at 3, if it stays there and doesn't go to 2, then a nominal neutral rate would be 3 plus 1 equals 4. If inflation does go further down, which is what the TIPS market suggests, but that doesn't mean it's correct, then maybe 3.5 is more plausible, right? The TIPS market, actually, we go to the previous chart, slide 1. The TIPS market has been saying all along, inflation's going to end up at 2.5 and stay there, right? So if that's the case, 2.5 plus 1 is 3.5, which, lo and behold, is exactly where the forward curve is landing in the next couple of years. So the market's being very rational in that sense. It's reading the sign from the TIPS break-even curve. It's looking at history of what is a neutral real rate, and it's just adding the two, and that's where the forward curve is. But it's a snapshot in time. My sense is, and that's the sense of my colleagues here, is that 3 kind of is the new 2, and in that sense we go to 4. But even that, 4 is a lot lower than 5 3/8, which is where we are now. And whether we go to 4 or to 3.5 is a question for next year, but not a question for today. For today, the answer is the Fed has permission from the data to start cutting, and it's going to cut, in September with 100% probability, and it's probably going to cut one more time later this year. And then probably a couple more times next year. But again, we'll see. Maybe we're in a recession next year and the Fed goes all the way to 2. So we don't really know. But the bigger question that I think you're hinting at is, again, one of what does the next 5 years look like?
Yeah, are we in an inflationary story here? And more broadly, lots of spending. And no cutting, really. I mean, fiscal cutting.
No, yeah. Austerity is a non-starter for most politicians. It's not a way to get reelected.
No, it's not.
But yes, so deficits are going to continue no matter who wins. So this is not a political issue. It's an issue, but not one on the political stage. And to me, really, the only question is, what role does the central bank play, right? So we see in the Bank of Japan that the central bank plays a subordinate role behind the fiscal side. The Fed did the same back in the 1940s during World War II. The Fed currently is on the other side of that. It is asserting its independence, and maybe no one has threatened its independence, so it can do that. But the Fed is restrictive while the fiscal side is loose, and that, I think, is a big reason why the dollar is strong. But 5 years from now, what is that going to look like? I don't think Congress is going to enact legislation that removes the Fed's independence or anything like that, but it can be much more subtle. Board governors can be put in place on the Fed that are more friendly to a more fiscally dominant, policy. And so we don't really know what that's going to look like. And even if we did, there is still not an easy answer, right? Because the conversation we've had is about the bond market and the term premium, which remains about 0.
Right.
And if you think about fiscal dominance and a subordinated Fed, you would think inflation would be high, and I think you would be correct, and that would justify a higher term premium. Right. But if on the other side, the Fed takes a page from the Bank of Japan and does yield curve control and QE to keep rates lower, then that actually would cause the term premium to go down or stay where it is. So even if you don't have the answer, and this is one of the fun dynamics of trying to figure out these puzzles, that even if you have the answer, doesn't even mean you get the direction of the trade right.
No, we're just gonna have to stay tuned to you. I think that's what that means. We'll see you next Monday. Jurrien Timmer, thank you for starting off our week.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.